Hi YouTube, Regina here from Simply Fundamental. So, today's topic, let's talk traditional 401k and Roth 401k. What are they? So, the IRS allows you to put money in your retirement, a certain amount each year. And it depends on your age, the amount you're allowed. So I think this year, if you're under 50, it is $23,000 for 2024 that you're allowed to put away, either tax-free or use money that you paid taxes for already and put within that retirement account. So let's go into what a traditional is and a traditional 401k is and a Roth 401k. So if you are taking the tax break this year that you go to put the money in, that would be considered a traditional. You're not paying taxes on that money before you put it in your 401k. And so that money earns and grows tax-free. But at some future point when you go to retire, you're going to have to pay taxes on that money. That's the traditional. The Roth 401k is where you pay the taxes on that money today. It grows tax-free. And at the point in the future that when you go to retire and whenever you want to take that money out after retirement, you don't have to pay taxes on it. It grows, and you could actually even leave it in there, and it can continue to grow tax-free. It's quite powerful. Now, I mentioned taxes. Taxes are a real big consideration when it comes to the decision between a traditional 401k and a Roth 401k. How do you decide if to take the tax break now or to take the tax break in the future? Well, your income has a big part of the decision, and also the income you're going to be earning in retirement, as well as the tax rate that you're currently in now, the amount of money you might have in your retirement currently, and whether you're going to have future income down the line in the future when you go to retire. So are you going to have a pension? Are you going to have other streams of income coming in when you're retired that would bump you into different tax brackets? So now let's get into the taxes. The U.S. is on a progressive tax system. And what that means is we have specific tax brackets. We have 7 of them. We have 10% tax bracket, a 12, a 24, 12, 20, 22, 24, 32, 35, and 37% tax bracket. Doesn't matter how much money you make, everyone gets to use the, everyone would fall in the, who earns an income, gets to use the 10% tax bracket. The next would be 12%, 22%, 24, 32, 35, and 37. And really, only the high income earners would ever see their money be taxed at the 37% tax bracket. Other people who are not earning super earners are not going to see that tax bracket. So it is people who are putting money in their retirement and are in a really high tax bracket. And I'll give you the example. So someone earning over $689,000 would be in the highest tax bracket. That's a nice problem to have if you're earning $670,000 to be in the 37% tax bracket. It doesn't mean that all your money would be taxed at that 37%. Quite the opposite. You still benefit from the 10%, the 12%, the 22, 24, 32, 35, 37. You move up each tax bracket. So these marginal tax brackets means it's potentially the next dollar that gets taxed at a different rate. So let me pull up the tax bracket so you see what I mean. So if you're a single filer, you have the tax bracket of 10% between 0 and 11,000, I think it says 600. And if you're married filing jointly, it's a little bit higher because it accounts for 2 incomes. But it's pretty much double the amount that you would get as a single filer is what it really falls into. So using the single filer in this example I'm going to be giving you, if you earn $100,000 a year, the first 11,000 would be taxed at 10%, 0 to 11,000. The next $11,601, even though it says 600 here, it's really 601. Then the penny you make above that amount then puts you into this 12% tax bracket up until you get to the 47,150. Then between 47,151 all the way up to 100,525, you would then fall in the 22% tax bracket. So if you're making $100,000 a year and you're going to put money in your retirement, you wouldn't be cutting off this tax bracket. That money would come from the top. And so the 100,000 would bring you to 90,000, and you would save the 22 cents on every dollar you put in your 401k. If you were doing traditional, the government would be putting the 22% for you because you wouldn't be paying taxes on that money that you're putting in. So you wouldn't feel like $100, for every dollar you put in wouldn't feel like $1. It would only feel like 78 cents less in your paycheck. The other thing to understand is the standard deduction. So the U.S. allows every individual to either itemize their taxes or take the standard deduction. And the standard deduction is basically the amount of money that you can get and earn tax-free. And so for a single filer, the standard deduction for 2024 would be $14,600. And again, for married filing jointly, it's basically just double the amount. It's pretty much almost double the amount. $14,600. So what that $14,600 means is the first $14,600 you make, you pay zero taxes. So really, before you move into the 10% tax bracket, you get that standard deduction. So you really only pay 10% on $14,000. If you make $15,000 a year, it's only $400 of money that would have been subject to the 10% tax bracket because the first $14,600 you make. So in addition to understanding what tax bracket is, from these numbers, you kind of almost have to deduct $14,500 from each top, like make this a little bit different. So what I mean for this is you would take the $14,600 standard deduction, and that's the 0% tax. Before you move into the 10% tax bracket, you now, my little headphone jumped out. You now jump into so it would be 14,001 to 25,000. I think it was 200. So you basically add 14,600 to this number, and that I think that actually brings you to 26,200. So 26,200. So 14,601 to 26,200 is when you fall in the 10% tax bracket. So 10% tax. That's not a lot. So if you're earning $60,000 a year, you then take, let me just do this. $26,000 all the way up to 63. I just added 14,000 to this number here. I added 14,600 to this number here because that is what brings you into the 12% tax bracket, not because of the standard deduction. Does it make sense if you're earning $60,000 a year to reduce your taxes below 12%? When you take that money out in retirement and it's tax-free, it may make more sense to take the Roth in that case because you're not taking it from the 12% tax, the 22% tax bracket. because of the standard deduction, you would have only really been paying 12% on that money. We don't know what future taxes are going to be. Right now, we are under the Trump tax cuts, and so these numbers are going to change. These tax rates are going to go up like 2% on each one of these. So these could end up being above the standard deduction. We might jump into the 12% as the cheapest tax rate, or I believe that's what it is. Anyway, so it makes the income you're earning now and the income that you could potentially be earning in the future is going to make a real big difference on whether or not you put it in traditional or you put it in Roth. But if you're a really high income earner and you're struggling and you have no means to put money in your retirement, maybe you could use the help of the government putting it in there for you. Because again, for every dollar you put in, if you're falling into any one of these higher tax brackets, it could significantly reduce. So if you are in the 24% tax bracket and you're earning over $100,000 a year, and let's say you're earning $150,000, it's going to cut from here. Even with the standard deduction of $14,600, you're still, all your money is going to be taxed within the 32% tax bracket. Maybe you can benefit from putting money in and for every dollar you put in, it feels only like you're putting in 68 cents and the government's putting in 32 cents for you because you're struggling and it's very difficult. Plus, when you go to take it out in retirement, now you're taking it out in retirement, you have no other sources of income, you're going to fall within the lower tax bracket. And even if these tax rates change in the future, which we kind of expect them to, you're still not going to be taxed 32% on your money. So it may make sense to do a traditional in that example. So you get to put a lot away each year. I hope that people, do that. You'll also get a match from your employer. In most cases, the employer will give you a match. I've made different decisions through the course of my career. There have been times where I put money in Roth, and there have been other times where I put money in traditional. So it's a decision that you can change each year. Some years it could be that you're just not earning enough money, or if you're in a situation and if it's you and your partner and one of you is not working, you're going to be pulling yourself into the lower tax bracket. So keep in mind, look at what the tax rates are each year and actually run the numbers. Does it make sense for you? What's the standard deduction? How much money is it going to be that you get to earn tax-free? How much income am I going to be getting in retirement? Those are the kind of decisions. But if you're a high income earner now, chances are you could benefit from doing a Roth. But by doing the traditional, you'll probably be earning less in retirement. However, that may not necessarily be the truth. If you're starting out and you're running a business and that business takes off and all of a sudden you have more money than you need, you could potentially be paying higher tax dollars on your money. So think about your own situation. It is an individual situation, but it also depends on the situation that you are. Are you filing as single? Are you filing as joint? And again, what tax bracket are you in now? Could you benefit from taking the tax break now or taking the tax break in the future? So I hope this is really helpful and that I didn't confuse the situation a bit more. And that you learned a little bit about our tax rate codes. And truthfully, even though you fall within these tax bracket, the standard deduction or whether you itemize and get more than the standard deduction is going to make a difference on how that money is really taxed as well. And of course, even in retirement, you get to take the standard deduction. And when you're over 65, you get even a bump in your standard deduction. I'm forgetting what it is for, when you're over 65, but you get additional tax benefit and an additional standard deduction for being over 65. Pretty awesome. So things to consider. Let me just say what it is for when you're over 65. So over 65, you get an additional $1,550 standard deduction. So in addition to the $14,600, when you're over 65, you're going to get an additional $1,550. So that's pretty nice. That's like $16,000 and change of not having to pay a single penny of tax on the first $16,000 and change that you make. That's pretty awesome. Anyway, this is Regina from Simply Fundamental, and if you have any comments or questions, I am not a tax advisor. I do love numbers. I do love these kind of things, but I'm not advising you exactly what to do with your money. But definitely look into it and play around with the numbers for yourself, and look at the tax rates that we have. And they change each year, so look at it each year. And hit me up in the comments and hit like and subscribe, and I will catch you on the next one. Thanks. Bye. My clicker never works.